Dr. Indrajit Coomaraswamy is the governor of the Central Bank of Sri Lanka and he will be giving our opening address. Dr. Indrajit Coomaraswamy has had his early education at the Royal College, Colombo, and the Harrow School in England. He obtained his undergraduate degree at Cambridge University and obtained his doctorate from the University of Sussex. Dr. Coomaraswamy joined the CBSL in 1973. He was part of the bank till 1989. During this period, he also served the Ministry of Finance and Planning for 8 years. During 1990 to 2008, he worked in the Commonwealth Secretariat, holding various positions such as Director, Economic Affairs Division, and Deputy Director of the Secretary General's Office. He was subsequently Interim Director of the Social Transformation Program Division, Commonwealth Secretariat, a post he held from January to July of 2010. Prior to being appointed as the governor of the central bank, Dr. Coomaraswamy served on the board of directors of one of Sri Lanka's top blue-chip conglomerates. Dr. Coomaraswamy is widely accepted as a reputed economist, serving as the deputy chairman of the Pathfinder Foundation. At the time of the latest appointment, Dr. Coomaraswamy is an advisor at the Ministry of Development, Strategies, and International Trade. I thank Dr. Indrajit Coomaraswamy and invite him to take the podium.
Honorable Minister, Your Excellency, Ambassador Dr. Palitha Kohonne, Your Excellencies, distinguished ladies and gentlemen, let me first say it's a great pleasure to be here with you, and particularly to welcome those of you who have come a long way to be here with us today. My theme for this presentation is the global economic situation and its implications for Sri Lanka. I'm going to twist it a little bit. I'm going to start by speaking about the global economic situation and to try to draw out some implications for Sri Lanka. But in my position, when one gets a captive audience like this, it's very difficult not to be tempted to make a pitch for what we are trying to do in terms of stabilizing the economy and enhancing its trajectory of growth. So I'll finish off by doing that. So if I may start with the global economy. For the first time since the global financial crisis, we're seeing synchronized growth in the major economies of the US, Europe, and Japan. Since 2008, one or the other has been in recession. And this, for the first time now, we see all these three major economies now recording positive growth. In fact, at the IMF World Bank annual meetings in October, where there is a large gathering of finance ministers, central bankers, and commercial bankers, the mood was positively upbeat, more upbeat than it has been for a number of years. And according to the IMF, global growth is expected to be 3.6% in 2017 and 3.7% in 2018, which is perceptibly higher than it has been in the last 8-9 years. The corresponding numbers for emerging market and developing countries are 4.6% for 2017 and 4.9% next year. And this pickup in global growth has been supported by notable improvements in trade and industrial production, coupled with strengthening business and consumer confidence. And until recently, there was the threat of deflation in some of the major economies in the world, and now, for the first time, that threat has receded. While the current upturn is positive, it's important to recognize that growth is still not as robust as it was during the so-called NICE decade. NICE decade standing for the non-inflationary continuous expansion that we saw between the Asian financial crisis in the late 1990s and the global financial crisis in 2008. That decade saw very robust growth and very dynamic international trade expansion, led by China in its role as the factory for the world. Now, despite the fact that the current situation is not quite as buoyant as it was during the so-called nice decade, despite this, global economic conditions are clearly now providing a tailwind to the growth prospects of both advanced as well as emerging and developing countries. Having said that, it is also important to recognize that there are some key risks that need to be mitigated and managed. So what are these risks? One is the specter of rising protectionism in advanced countries, notably in the US and Europe. A second risk is the divergence of monetary policy in the major economies. Until recently, the monetary policy cycle of the US, Europe, and Japan was broadly convergent. But we are now seeing a non-synchronization of this monetary policy, with the US ahead in terms of the interest rate cycle, the normalization of the interest rate cycle, followed by Europe, with Japan still in a mode of quantitative easing to push up their rate of inflation, which is proving stubbornly difficult to do. Now, what are the implications of this divergence of monetary policy in the major economies? The key implication is that there is likely to be greater volatility in both asset markets and currency markets. And the VIX index, the volatility index, which has remained very subdued for a number of years, is now likely to rise. Now, the normalization, a third risk, so we've had the specter of rising protectionism, a second is the divergence of monetary policy, and a third risk arises from the normalization of monetary policy in the US in particular, as well as by the European Central Bank. This is very much uncharted territory. There could be unintended consequences and unexpected outcomes. However, it's important that these central banks manage the transition, manage the normalization of their monetary policy in such a way that it's not disruptive not only to their own economies, but to the global economy, as the policies in these countries have an impact across their borders. A fourth risk is the increase that we have seen in oil prices. A combination of the pickup in growth, which has created additional demand for fuel, as well as the effective production cutbacks on the part of OPEC and Russia, has meant that we have seen an increase in the oil price up to about $60 US. If it goes much higher, then it could have negative adverse impacts for a number of countries, the non-oil developing countries in particular. We have seen in the past that spikes in oil prices lead to global recession. However, when I come to commodities, I'll say a little bit more about it. The dynamics of the oil market have now changed, and hopefully we won't see oil prices go much above $60. The next risk I'd like to speak about is the impact of the increased frequency and intensity of extreme weather events. Natural disasters have become more intense and more frequent. And one needs now to build in sustainability into budgetary and planning processes in such a way as to both mitigate the impact of climate change, as well as to initiate adaptation measures to cope with the effects of climate change. And the final risks are geopolitical risks, related particularly to Iran and North Korea. But for us in this region, we've also seen the dynamics of geopolitics in the Indian Ocean region change. And one needs to factor that in as well in terms of the risk matrix that we need to address. Let me now say a little bit about what is expected in the advanced countries first, and then the emerging and developing countries. Now, the advanced countries collectively are projected to grow by 2.2% in 2017 and by 2% in 2018, supported by cyclical recovery in manufacturing and trade, as well as an upturn in financial markets. As I said before, the persistent recession and the threat of deflation have now abated. Let me now take the three major advanced countries one by one quickly. The United States economy, which is Sri Lanka's largest export market, is expected to grow by 2.2% in 2017 and 2.3% in 2018. These numbers are from the IMF, by the way. The numbers I'm citing are from the IMF. And unemployment is also at historically low levels. Now, it is important, I think, for the world at large, that the US does not retreat into isolationism. Despite the reduction in the weight of the US economy in the global economy, the US policies continue to have a major impact on the rest of the world. An outward-looking and engaged United States can be a major force for good. For this, protectionism and isolationism should be resisted in the interest of both the United States and the rest of the world. If I may say a little bit about the Federal Reserve's normalization of its monetary policy. Now, it's widely expected that interest rates will go up and that the Fed will unwind its very large balance sheet, the balance sheet that it has built up through large-scale quantitative easing in the last 7-8 years. Now, it's expected that there will be a rate rise in December and 2 or 3 rate rises in the next year. The positive feature is that the Fed has provided plenty of forward guidance in preparing markets for this. This is why global financial conditions remain benign despite the prospect of the normalization of interest rates in the US. The new Federal Reserve President Jerome Powell is expected to continue Janet Yellen's, the former president of the Fed's, dovish monetary stance. Now, we are likely to clearly see some tightening of the interest rates in the US, given the fact that growth is picking up and the labor market is tight. And of course, if the current US administration is successful in its efforts to reform its tax system, and if infrastructure development gathers momentum, then there could be a major boost to the US economy, and we could see the growth impulses being much stronger, and the pressure for normalization of interest rates could be greater. But the expectation is that it's going to be very gradual, and that the peak of the interest rate cycle is going to be lower than has been in the past. Let me now turn to the Eurozone. After a fairly lengthy period of very sluggish growth, when it lagged other regions, the Eurozone is now beginning to experience better prospects. Growth in Europe is becoming more resilient and broad-based, with southern European countries also sharing in the recovery after the severe recession that they experienced in the period immediately after the global financial crisis. Now, a risk for Europe is the fact that banking reform there is less advanced than in the US. This continues to be a source of uncertainty. However, this risk can be managed if the European economy continues to grow and the ECB, the European Central Bank, is able to normalize monetary policy, including the tapering of its asset purchase program, without disruption. So we're beginning to see greater dynamism in the European economy as well. And within Europe, if I may also talk about the UK, which is of course not in the Eurozone, it has its own currency. Growth in the UK, which is Sri Lanka's second largest export market, is projected at 1.7% in 2017 and 1.5% in 2018. Prospects of the UK continue to be marked by the uncertainty surrounding the post-Brexit arrangements. A lot will depend on whether there is a hard or soft Brexit. A major sticking point is the difference in views regarding the budgetary settlement, i.e. the divorce payment associated with the UK's exit. A hard exit will have serious repercussions for the British economy in terms of lost output, incomes and employment. New investment will be deterred, and a number of existing companies are likely to shift some or all of their operations out of Britain. And the City of London is particularly vulnerable in this respect, and Frankfurt and Paris stand to gain if there is a hard exit. The net effect of Brexit will depend on how successful Britain will be in negotiating new market access arrangements with non-European countries. Of course, it has a good relationship with the US, but the current US administration is not particularly interested in trade deals. There is also the possibility of reviving Commonwealth trade and investment links. Commonwealth has markets such as India, Australia, Canada, New Zealand, Malaysia, Singapore, Nigeria, and South Africa, but this clearly is something that would need to be built up. Because Britain, in the first 20 years after the Second World War, was focused on the Commonwealth and not really on Europe. Subsequently, it's flipped, and it pretty much ignored the Commonwealth and was focused very much on Europe. So now, trying to restore those Commonwealth ties is something that the UK is beginning to give priority to. Let me talk a little bit about the emerging markets and developing countries. The IMF's growth projection for emerging markets and developing economies is 4.6% for 2017 and 4.9% for 2018. And Asia remains the fastest growing region. And within Asia, however, the slowdown in India has meant that in recent quarters has meant that South Asia is no longer the fastest growing sub-region in Asia, and East and Southeast Asia has again become the fastest growing region. It's important to note that China, despite some slowdown in its growth, accounts for 39% of world economic growth. It accounted for 39% of world economic growth in 2016. And if you take India and China together, they account for almost 60% of global economic growth. Now, of course, that the new normal for Chinese growth is about 6.5%, slowing down from the accelerated double-digit growth that China has experienced for a couple of decades. But in considering that, one must recognize that this is now a 11.9 trillion economy. So 6.5% of 11.9 trillion economy in terms of value created, output generated, demand created, is likely to be as large, if not larger, than a 10% growth in a smaller economy 5-10 years ago. So in terms of the impact of Chinese growth on the global economy, this 6.5% is going to be very considerable, continue to be very considerable. And China is making good progress in rebalancing its economy. Progress is being made in shifting from external to domestic demand, from investment to consumption. And the quality of growth is also being improved. As you know, environmental challenges have been a major consideration for the Chinese authorities. There is large amounts of money being invested in solar energy and electric cars. And China is firmly committed to the Paris Declaration and is focused on mainstreaming sustainability into its planning and budgetary processes. And going forward, the rest of the world, pretty much the whole world, certainly Asia, Africa, and parts of Europe are going to benefit from the investment and the demand for materials associated with the One Belt, One Road initiative. The demand for materials for this will boost commodity prices, benefiting countries in Africa, Asia, Latin America. And the infrastructure development and the improved connectivity is going to benefit a huge swathe of the globe. On India, Indian growth has been slowing over the last year due to the effects of demonetization and the initial teething problems associated with the introduction of the goods and services tax. However, these are likely to be short-term effects, and the Indian economy is expected to recover. In fact, the GST, the goods and services tax, is sold as constituting a one nation, one tax, one market. For the first time, there will be a single market in India once the GST beds down. So one can expect the Indian economy to recover and to experience 7.5% plus growth in the medium term. On commodities, as the global economy experiences an upturn and there is increased demand, commodity prices tend to rise. And as far as oil prices are concerned, as I said, the increase in demand combined with the successful production cuts by OPEC and Russia has meant that there has been this little spike in oil prices. However, Saudi Arabia is no longer the swing producer as far as the oil price is concerned. It is the US shale production. The US is able to ramp up oil production very quickly once the price goes much above $60. So that is sort of the limit. As the price moves above $60, it's interesting now, we saw a spike in prices. When it got to 60, it has tended to tail off, and one is beginning to see new rigs open up in the US. So these are some of the things. If I've kind of quickly gone through the general global economic conditions, the advanced economies, the conditions in the major emerging markets and developing countries. So what are the implications for Sri Lanka of all this? And there are different channels through which Sri Lanka is affected. The first is trade. Sri Lanka's major export markets, as I said, the US and Europe have experienced recovery. In addition, India, which is the third largest export market, is expected to turn around and have accelerated growth. So the prospects for Sri Lanka in terms of its key markets are positive. And we are beginning to see that in our export numbers. If you look at the Sri Lanka's export performance in the last 4 or 5 years, there has been a pickup. 4 or 5 months rather, there has been a pickup. And of course, the restoration of GSP Plus and the removal of the EU's fishing ban has helped us, and we're beginning to see the benefits of that coming through as well. And as far as India is concerned, and the accelerated rate of growth, though we've had proximity in the past, the fact that infrastructure in both countries was particularly weak meant that there was distance created because of the very high transaction costs that are associated with poor infrastructure. However, infrastructure is now improving in both countries, and that is going to mean that there will be a better set of conditions to be able to take advantage of the proximity to that very large market as far as Sri Lanka is concerned, particularly the 5 southern states of India, which have experienced double-digit growth now for a number of years. Then on the import side for Sri Lanka, that's on the export side. So the trade channel is one way we get affected. So there are very positive trends as far as the exports are concerned in terms of what is happening in the global economy. There are very strong tailwinds which will help Sri Lanka's growth prospects. On the import side, of course, a firmer oil price does mean that energy costs will increase. But our other import commodities, such as flour, sugar, milk food, etc., are more linked to agricultural production rather than the business cycle. Unlike industrial raw materials like iron ore, steel, copper, etc., which are linked, where the prices are linked to the business cycle, our commodities tend to be linked to agricultural production, and therefore this upturn in global economic growth is not directly linked to the prices of commodities that we import. So a second channel through which we get affected are capital flows. So on FDI, what's there on the horizon? Sri Lanka has excellent relations with all the capital surplus countries of East and Southeast Asia. From China, Japan, South Korea. The president is in South Korea at the moment. The ASEAN countries. Sri Lanka has excellent relations with all of them, and the prospects of attracting investment from all of them is out there for Sri Lanka to grasp. Now, one particular phenomenon that needs to be taken special cognizance of is the fact that China, like Japan in the 1980s, is moving to a phase where it is moving from the export or a laser-like focus on the export of goods to now a much greater focus on the export of capital. And it is going to use the One Belt, One Road initiative to export capital, those two major arteries, the land route and the sea route, to export capital. And Sri Lanka is fortunate in that it is right at the center, right in the middle of the maritime Silk Route, which will give Sri Lanka a great opportunity to take advantage of this massive outflow of capital that is going to take place from China in the next 10, 20 years. Another channel is institutional investor flows. And here we've already seen, I think we've heard earlier, the stock exchange has had the highest inflows ever this year. Of course, there, if we see a pickup in yields in the advanced economy, then it's going to be more challenging to attract institutional investor flows to emerging and frontier markets. And for that, that means that there has to be an even higher premium attached to sound economic management so that this money can be attracted. Sri Lanka this year has been fortunate. We've attracted money both to the stock market and the government securities market, and we need to maintain good, sound economic management to continue to do that. Long-term debt, sovereign bonds, syndicated loans, etc. Here the costs are likely to rise as US interest rates go up. However, Sri Lanka had an opportunity. Because Sri Lanka has historically been a twin deficit country, there has been a large premium above the risk-free rate, that is the US Treasury rate. There has been a large premium above that in terms of the cost of our borrowing. Now, if we are able to strengthen our economic performance, if we are able to make our macroeconomic fundamentals more robust, we can compress that differential between the US Treasury rate and our own borrowing rates. And that can compensate for any increase in the US interest rates. So by reducing the differential, we offset the increase in US interest rates. Remittances, the higher oil prices clearly are friendly for them. And as far as tourism is concerned, recovery in Europe would be helpful. Simply because historically Western Europe has been a major source of tourism. It's now slipped behind India and China, but tourists from Western Europe are relatively high spenders, so recovery should help us. So in conclusion of this section of my presentation, there are tailwinds in the world economy which are positive for Sri Lanka, and we need to be able to take advantage of them. Let me now very quickly say what we are doing in terms of strengthening the macroeconomic fundamentals of the country. Historically, Sri Lanka has been a country with stop-go policies. The main source of instability has been the fiscal deficit, which has pumped excess demand into the system. But the government is now putting in place clear frameworks for macroeconomic management. One, there is a revenue enhancement-based fiscal consolidation program which envisages the fiscal deficit to come down to 3.5% of GDP by 2020. And that program is embedded in the IMF's extended fund facility arrangement that Sri Lanka has agreed to. And not only that, the government is seeking to institutionalize this framework, the fiscal framework, by strengthening the Fiscal Management Responsibility Act by giving it further teeth, whereby the government will be able to deviate from the targets in that Fiscal Responsibility Management Act for very specific reasons, like natural disasters or severe recession, and if they do deviate, they have to set out a path as to how they will revert back within the target. So you have a framework for fiscal consolidation and an attempt to institutionalize that framework. Similarly, on monetary policy, the central bank is introducing a flexible inflation targeting regime, and we are putting in place legal and accountability frameworks to institutionalize that flexible inflation targeting regime, which will be much more data-driven, forward-looking, and proactive than monetary policy in the past. We're also setting in place clear parameters for managing our exchange rate. We don't plan to spend out scarce reserves to defend an exchange rate which is indefensible. Let me let the minister come and sit. So I was just saying that we are putting in place some frameworks for macroeconomic management on the fiscal side, on the monetary side, on the exchange rate side, and the fourth framework relates to liability management. Sri Lanka has the challenge of raising a lot of money. It's a peak in its domestic debt repayment next year. But fortunately, in the last 5 months of this year, we do not have any debt maturities, which is giving us a chance to collect some money to act as a buffer to manage this peak in domestic debt next year. And we're also putting in place a liability management act, which will give us the space to raise money to address the bunching of external debt, which takes place from 2019 onwards. Not only that, the government has also taken a decision to earmark all the proceeds of divestiture, the sale or long lease of government assets. The proceeds will be credited into special accounts, which will be earmarked for debt servicing. For instance, the $1.1 billion from the long lease of Hambantota Port to China Merchant will be earmarked for debt repayment. So we have these clear frameworks which we think will give us greater consistency and predictability in our policies. On top of that, there is a considerable amount of work being done to strengthen the growth framework, to improve the investment climate, to strengthen investment promotion, to have much more, to reduce the costs of trade by taking several measures to improve trade facilitation, notably the single electronic window in the customs. And finally, let me just say a word about trade policy. Sri Lanka has a bilateral trade agreement with India in goods. The idea is to get an early harvest in terms of improving the working of the current agreement, which has not worked quite as well as we would like. But there is an effort to be made to see how we can make the current agreement work better, and then to extend the agreement to include not just goods, but services, investment, training, and technology. A similar agreement is being negotiated with China and Singapore. The agreement with Singapore is expected to be signed early next year, and hopefully the agreements with China and India will be signed by the middle of next year. Now, what is interesting about these trade agreements is that Sri Lanka will be the only country in the world which will have preferential access to China, India, and Europe. Europe because of the GSP+. There is no other country which can say that it has preferential access to these three very large markets. There are 190 countries all chasing after foreign direct investment. So the real prize of these trade agreements is to show this preferential access to these markets to attract investors in here, to tell people, come here, you can sell on a preferential basis to China, you can sell on a preferential basis to India, you can sell on a preferential basis to Europe. This is a massive differentiator which Sri Lanka is able to take advantage of if it is able to complete these trade agreements. Also, you combine that with our location, and you have clearly a massive opportunity for the country. So let me finish by saying the global economy has a number of tailwinds for Sri Lanka. The macroeconomic fundamentals are being strengthened through clear frameworks which are being put in place to provide consistent and predictable policies. The growth framework is being improved through, as I said, efforts to improve the investment climate as well as the trading environment. And of course, we have location and we have excellent international relations with all the countries in the world, the capital surplus countries as well as countries which are our markets. So when you take all that together, Sri Lanka presents you with a great opportunity. Thank you very much.